Investing in personal finance always sounds overwhelming and complicated because it's made to sound that way on purpose. On one hand, we've got financial advisors who want to get paid 1% of your net worth annually to underperform the market for you and to sell you overpriced life insurance policies. Then on the other hand, we've got those fake Finfluencer guru types who always act like they've got it figured out. It's always the same crap over and over again with those guys. They want you to buy the stock riding the support line of the Brontosaurus bull cross pattern, or buy the crypto that's being pumped on 4chan, the Elliott wave's fifth and final form. It's always a convoluted mess that'll get you absolutely nowhere except into some YouTuber's $4,000 mastermind course. The reality is that Finfluencers and even actual financial advisors all know that to keep you engaged in their product or service, your finances need to sound like something that you can't control on your own. They need to sound complicated, but you don't need to spend your life waist deep in YouTube finance videos or under pressure from some financial advisor who's just gonna get you to buy into his high fee mutual fund. The honest truth is that you only need to do 3 things to build a very strong financial foundation. These are not 3 vague concepts, but 3 practical activities that you can start today. If you do them, you can stop watching my channel. You can stop watching every finance video on YouTube ever, and you can withdraw your money from your financial advisor's rip-off mutual fund. Let's minimize the time you spend thinking about finance so that you can focus on expanding your career instead. Step 1, this is the most critical. If you want to be financially free, your very first step is to crush all of your high interest debt. Don't even think about investing until your credit cards are clean at the end of every month. With almost all credit cards charging more than 20% interest, there is no financial instrument on earth that is going to outperform ridding yourself of this debt. This is even more true when you consider that the people who carry balances on their credit cards often have the lowest credit scores, and therefore face APRs as high as 27%. Your very first priority should be to pay off your debts, starting with the highest interest and working your way to the lowest interest. For example, imagine you have 4 different types of debt. You carry a balance on 2 different credit cards. The higher one is charging you 25% interest, and the lower one is charging you 20% interest. You also have an auto loan at 6% and student loans at 4%. You should pay the minimum into the 3 lower interest debts and pay as much as you can afford into the highest interest credit card. Do not make additional payments into your 6% interest auto loan when you're carrying a balance on a 25% credit card, even if the total balance is much higher on the auto loan. Your goal is to minimize the amount of interest you're paying, and making an additional $100 payment toward your 25% credit card is going to save you more money on interest than paying that same amount toward your 6% auto loan, regardless of what the outstanding balance is. This is called the debt avalanche method, and it's widely regarded as the best way to minimize the negative impacts of interest while you climb out of debt. Disregard investing in any financial instrument until you have cleared those debts. There's only one exception. If your employer is offering you a match on your 401k investments, then take that free 100% return by investing up to that match if you can afford to. That's it. Do not invest any further until you have paid off your high interest debt. But we must also consider what makes debt high interest. If you have a 4% student loan, is that high interest debt? Some people use the S&P 500's average return as a benchmark. They say if you can make 7% returns on average in the market, then you should pay off any high interest debt above 7% and make the minimum payments on the rest. Just invest your extra cash flow into the market. I can't make that choice for you, but I can offer some advice. Do you want to be carrying 5% interest debt while dumping your money into the S&P 500, which lost 18% in 2022? The market doesn't go up a predictable 7% each year. It's volatile. Instead, I recommend using the 10-year Treasury bonds after-tax return as your benchmark. That return is indeed predictable, and as of this writing in July 2023, the 10-year is paying 4% annually. So does that mean for your debts above 4%, you should pay them off, and any debts 3.9% or below you should carry and invest the rest into treasuries? Not quite, because when you make money on bonds, you still need to pay tax. You must use the after-tax return on the risk-free rate. So let's take 15% off and call it 3.4%. Any debts that you have higher than 3.4% interest, you should absolutely pay off. You might be able to fudge a little bit if you have a very high mortgage and you itemize your taxes. Because you get to write the mortgage interest off of your taxes, the cost of carrying the mortgage is slightly lower than the interest rate. For everyone else and all other debts, kill your debt. It's just my 2 cents. If you absolutely cannot pay off your debts with your current income and you've already slashed all the expenses you can, then I strongly recommend my Freeloader Challenge series. It'll help you fill some gaps in your budget while you get back on track. Step 2, this will be controversial, so be ready. Get some life insurance. This does not need to be an expensive and complicated process. I'm going to make it very easy for you with just one question. Can you spell S&P 500? If you said no, that's okay, but you need a whole life policy. If you said yes, then you need a term life policy. I know the insurance agents want to punch their screen right now, but just so you know, I might also be a licensed life insurance agent in the state of Georgia. And I can tell you now that if you know what the S&P 500 is and you're willing to invest in it, then just get the term life policy and invest the rest. However, this is not financial advice, ask your doctor, etc. Term life is an insurance policy that will expire in the future. It is very inexpensive to own one, and if you die, then your family will get a huge payout. You're basically buying at the money puts on your life. For example, I have a $650,000 term life policy. If I die before 2050, my family will get $650,000 in cash. If I do not die, then my insurance expires and I have wasted all the money that I spent on the policy. If you don't die, you're screwed. For this reason, some people, especially those selling these policies, will say that you need whole life insurance. These are much more expensive to carry than term life, but it doesn't expire. In fact, as you put money into the plan, it will build what's called cash value. If you ever end up canceling your insurance policy, you can withdraw the cash value, or you can borrow from the cash value without having to cancel the policy. Over the very long term, and I'm talking like 30 years or more, you can eventually borrow from the cash value without having to pay taxes in order to fund your life expenses. It's not a bad deal. I have a $150,000 whole life policy in addition to the term policy. But here's the trick. If you have the discipline to invest in the S&P 500, then your share portfolio will almost certainly outperform the cash value of your life insurance policy over 30 years, even after you consider the effects of taxes. You're exceedingly likely to be much better off by just buying the cheap term insurance and completely ignoring the expensive whole life policies. Just pay the premium on the cheap term insurance and put the rest of your money into shares of VOO instead. If you have a job that offers you group life insurance, I still recommend getting a term life policy on your own in addition, because if you get fired or laid off, then that group insurance goes away. If you wait until after that happens before you get the insurance, then you will be older and therefore your insurance premiums are going to be higher. Term life can get much more expensive as you age, so your best bet is to get a nice long policy while you're still young. Even if you're on a budget, you can still afford term life. A $100,000 term life policy is like $4 a month. At least pay for your own funeral, freaking cheapskate. And I'm just being real about this. I don't mean to say this disrespectfully, but if investing in VOO shares sounds too complicated for you, then just get a $500,000 whole life policy and don't worry about a thing. You'll be fine. At most, consider getting a larger term life policy and a smaller whole life policy, just like I did. Don't make it any more complicated than that. And step 3 of the only financial planning you need to do. This is what's going to separate you from the pack. We're going to use a novel investing approach called buying indexed ETFs. An ETF is an exchange-traded fund. This is a low-cost way to invest in a diversified manner. I'm being a little bit sarcastic because this is a very easy investing strategy that will put you ahead of almost everybody, but not nearly enough people are actually doing it. Stay disciplined and invest what you can afford. Ideally, you should be investing 20% of your take-home pay into indexed ETFs. The reason I say to invest this way is because 95% of traders do worse off by trying to invest on their own. Half of traders will lose money when they speculate in the market. Of those who do make money, most of them still underperform the S&P. And even those who outperform the S&P, remember that those trading gains get taxed. So if you beat the S&P by 5%, you might still be underperforming by the time you're done paying your taxes. When you figure out who is left standing versus the S&P, it is a very low single-digit percentage of investors. If you insist on trying to be one of them, then do that after you already have tens of thousands of dollars invested into indexed ETFs. My non-professional recommendation is to buy from among the following. If you are young, more than 20 years from retirement, buy VOO and/or VT. VOO is the S&P 500. That's a basket of the 500 largest US companies. VT is a very diversified portfolio across all of the world's stock markets. Both VOO and VT will go up and down over time. But this far from retirement, you can safely ignore the short-term changes. When you're within 10 years of retirement, you should seriously consider lowering your risk by taking some of your investments and moving them into fixed income or lower volatility instruments. Or you can add bonds or other fixed income instruments to your portfolio. Although a growth portfolio like being 100% invested in VOO will usually outperform over the long term, imagine being 2 years from retirement and seeing a bear market crush 30% of your holdings. Now what are you gonna do? This would have been a great time to buy when you were younger, but this is not what you need when you're getting ready for retirement. A popular technique is to migrate your holdings into what's called a 60-40 portfolio. You have 60% of your holdings in growth like VOO and put the other 40% into bonds or other fixed income instruments. If the market does very poorly shortly before your retirement, you will be somewhat insulated from this because you have a smaller proportion of your portfolio invested into the volatile markets. Meanwhile, your bonds will continue maturing and you will continue getting paid. You also have the option to put more money into dividend ETFs, which generally have lower volatility and pay you out continuously. And of course, when you are in retirement, it makes sense to minimize the risk you need to take in order to fund the lifestyle you want. If you can live comfortably and fund all of your ambitions in life by putting your money into treasury bonds, then go for it. However, most people are still going to want some exposure to growth so that those assets can continue appreciating and they can pass it on to their children. And additionally, if you do have a whole life insurance policy, then this is the time where you can start to borrow from its cash value. But worry about estate planning later. For now, if you are among my typical viewer demographics, you probably need to be investing pretty heavily into those diversified indexed ETFs like VOO. Do not burden yourself by trying to figure out which broker to use. They're all basically the same thing. Just pick a broker and invest in the S&P 500. I know this is all easier said than done, but don't worry, Mikey Millions has your back. I made enough money during the Freeloader Challenge to max out my IRA in back-to-back years. So if you are really struggling and cannot make ends meet, then let me show you how to put some extra money in your pockets. We're gonna use focus groups, promotion churning, and some other simple side hustles. This is not a paid course, it's just a YouTube playlist and everything is free. Also, join our Discord and we'll get you on track with both investing and freeloading. Thanks for watching, and I hope to see you on Discord.